Financial Accounting, Introduction to Accounting Cycle. Part 1. The accounting cycle starts with journal entry and, it, ends with financial statements for the current year. The accounting cycle steps. 1. Record journal from an event. 2. Posting to ledgers. 3. Trial balance. 4. Adjustments. 5. Adjusted trial balance. 6. Preparing income statement. 7. Closing entries. 8. Statement of retained earning. 9. Post-closing trial balance. 10. Other statements preparation. Step 1. Record journal from an event. Accounting journal entry comprises several parts. 1. Date. 2. Debit side with the account name. 3. Credit side with the account name. 4. Amount of cash is required to include for each side. 5. An explanation. The first transaction, Company Y initially issued 1,000 common stock shares of $100 par value for $100,000. In this journal entry, cash of $100,000 should be debited and the common stock credited for $100,000. The second transaction is about purchasing prepaid rent. The journal entry would be a debit to prepaid rent for $10,000, with a corresponding credit to cash for $10,000. The explanation of this journal entry is paid rent in advance for 1 year. The third transaction, Company Y received $10,000 cash payment in advance before goods delivery to the customer. Under this circumstance, cash is debited for $10,000 and unearned revenue is credited with an equivalent amount. Step 2. Posting to ledgers. General ledger for each account contains several parts. 1. Account name. 2. Dates. 3. Reference. 4. Debit side. 5. Credit side. 6. Balance. We have 4 general ledgers. Cash. Common stock. Prepaid rent. Unearned revenues. First transaction affects 2 ledger accounts, cash and common stock. Company posted $100,000 in account number 101, and $100,000 in account number 808. Second transaction affects 2 ledger accounts, prepaid rent and cash. Company posted $10,000 in account number 110 and a reduction of $10,000 in account number 101. Third transaction affects 2 ledger accounts, cash and unearned revenue. Company posted $10,000 in account number 101, and $10,000 in account number 660. Step 3. Trial balance. Trial balance for each account encompasses more than one element. 1. Account name. 2. All real accounts. 3. All nominal accounts. 4. Debit side with numbers. 5. Credit side with numbers. 6. Total of debit side and credit side. Accountants create trial balance from ledger's accounts. 1. $100,000 of cash in account number 101 is transferred to trial balance. Two. $100,000 of common stock in account number 808 is transferred to trial balance. 3. $10,000 of prepaid rent in account number 110 is transferred to trial balance. 4. $10,000 of unearned revenue in account number 660 is transferred to trial balance. 5. Total debit side equals total credit side. Step 4. Adjustments. Types of adjustment. 1. Deferrals. 2. Accruals. The first type of adjustment is deferrals. There are two types of deferrals. 1. Prepaid expenses. 2. Unearned revenues. Deferrals. 1. Prepaid expenses. The first adjusting transaction, prepaid rent expired during the year for 1 month. Debit rent expense for $833 and credit prepaid rent for $833. There were 11 months of prepaid rent left, which are considered as unadjusted amount. Deferrals. 2. Unearned revenues. The unearned revenues journal entry. Company Y debited $10,000 of unearned revenue because goods has been delivered to the customer. The accountant should credit $10,000 to sales revenue and debit $10,000 to unearned revenue. The second type of adjustment is accruals. There are two types of accruals. 1. Accrued revenues. 2. Accrued expenses. Accruals. 1. Accrued revenues. The accrued revenues journal entry is revenues recognition for sales of goods. An accounting transaction is made to debit account receivable for $10,000 and credit sales revenue for $10,000. Accruals. 2. Accrued expenses. The accrued expenses journal entry. Salaries and wages of $10,000 earned by employees. The journal entry can be done by a debit to salaries and wages expense for $10,000 and a credit to salaries and wages payable for $10,000. Adjusting entries posting to ledgers. The first adjusting transaction affects two ledger accounts: rent expense and prepaid rent. Company posted $833 in account number 1160 and a reduction of $833 in account number 110. The second transaction affects two ledger accounts: unearned revenue and sales revenue. Company posted reduction of $10,000 in account number 660. On the other hand, it posted $10,000 in account number 1000. The third transaction affects two ledger accounts: account receivable and sales revenue. Company posted $10,000 in account number 200 and $10,000 in account number 1000. The fourth transaction affects two ledger accounts: salaries and wages expense and salaries and wages payable. Company posted $10,000 in account number 1200 and $10,000 in account number 720.